So I think let's start. I should want to. Good morning, everybody. Good afternoon and good evening, wherever you're joining from. Welcome to the webinar, Dealmaking in the Current Environment. This is a webinar that was organized by the Swiss HLG and the PLG Benelux. Let me just share the screen, the presentation here, and there we go. Okay, can you see the screen?
Not yet.
Not yet, it's taking time. Okay.
Yeah.
Now you can see it.
Yeah.
Okay. So my name is Luis Vieira. I'm the BD lead at Health and Healthcare and also a board member at the Swiss HLG. So for our webinar today, we have two fantastic speakers. We have Nadine Maalouf, who's the Managing Director at Lanschot Kempen, and she's going to be talking about the M&A landscape and fundraising in the EU. Then we'll have Julia Schieber, a partner at Baker McKenzie, and she's going to do more of a legal take on when to do an M&A and when to do licensing. Each speaker will have about 30 minutes, and then at the end we'll have 30 minutes for Q&A. So please put all your questions in the chat, in the Teams chat, and we'll try and answer as many as possible during our 30 minutes of Q&A. So before we go to the presentations, just a couple of slides. Oops, why is it not moving? There you go. Okay, so one slide on the Swiss HLG. This is a group that was founded 22 years ago for business development professionals in the healthcare industry. And we want to provide an excellent environment for biopharma deal makers to network, learn, share experiences, exchange ideas, and develop best practices. We organize every year an annual conference, which is of the highest standard and a great networking event. And we'll show in the next slide a little bit more about that. In addition to educational webinars, we also offer local networking events, share good partnering practices, and run a startup initiative focused on deal-making skills. And if you want to learn more about this and the Swiss HLG in general, please visit our website at swisshlg.com. So in terms of the conference, it will be held in Montreux at the Grand Hotel Swiss Majestic from the 26th to the 28th of May. The theme of the event is Back to Deal Making. And we have a host of great speakers, starting with a keynote by Ed Salzman from Luminity. So I suggest that you go to our website and register for this event. So now I'll pass the floor on to Nadine, and she can to present M&A landscape and fundraising in the EU. So Nadine, the floor's on to you.
Yeah, thank you. Thank you, Luis, for the nice intro. Maybe before starting, just a few words on the Benelux Health Alliance. So we're very happy to have our first event today with the Swiss HLG. The Benelux Health Alliance is very fresh, actually. This was launched last September on the occasion of IPLS conference in Amsterdam. And the purpose of this association is basically to favor deal making in terms of research collaborations, BD licensing or M&A between academia, large pharma, medium-sized pharma, and biotechs. And this is driven by the high level of innovation we see in the Benelux on the biotech side, where we see leading players like Genmab, Organics, Galapagos, Miris, and others. Now, before diving into my presentation, I wanted also to take the opportunity to share with you a few words about Lanschot Kempen. So we can go to the next slide. Basically, the one after, sorry, Luis. So basically, we are an investment bank boutique present in many sectors, including real estate, financial institution, fintech, etc. But life science and healthcare is a key focus sector for us. We're located in the financial district of Amsterdam, and we have offices in Antwerp, London, and in New York. And if we look at the next slide, life science and healthcare is a key focus sector for us. So we executed more than 200 transactions since the inception of the franchise in 2005, raising around 44 billion over the last 4 years. We have a large network of institutional specialists and generalist investors, not only in Europe, but also in the US. And we have one of the largest equity research teams in Europe, covering 55 companies around Europe, and we're very active both on equity capital markets and on the M&A side, acting as financial advisor either on a buy side or a sell side. And the last deal where we were involved is a divestment of Giselica, which is a JAK inhibitor from Galapagos to Alpha Sigma in Italy. I'm happy to address after any further questions here you have on Lanschot Kempen. Now we could move directly into the presentation. So to share with you the agenda for today, as Luis mentioned, we will be tackling both the trends on the public side and on the private side, and with a special also view on what's happening in the M&A field. Moving to the next slide. Thank you, Luis. So here, if we look at the general market performance over the last 12 months, so if we look at indexes like the MSCI, the Nasdaq Biotech, or the European Life Science and Innovation Index, you see robust momentum in Q4 last year, which luckily extended to the first months of 2024. And we hope that this positivity and level of optimism continue to be maintained throughout the year. We see equities reaching record highs across the board, and this is largely driven by resilient economic data from the US, relatively strong earning reports, while in Europe, economic activity is showing signs of marginal growth, but we're pretty confident that things will continue moving in the right direction, and especially if we look at the interest rates. So if we move to the next slide, interest rate cuts are expected towards the summer in major economy. We've seen central banks having refrained from cutting interest rates, mainly to keep inflation under control. But it's no surprise that those rate cut expectations were on top of mind already in Q4 last year, where those cuts were anticipated as early as March. Now things are shifting towards the middle of the year. So we're speaking about June or the September timeframe. And the European Central Bank is expected to be the first bank, if you wanted to cut rates, contrary to previous expectations that the Fed in the US would take the lead. So if you look at the second graph on the screen, the market expects around 70 basis points of easing in 2024. And recent data about US consumer price and producer price showed that inflation exceeded forecast, which reaffirmed basically our beliefs that the Fed will not rush to reduce interest rates because they want to see better inflation under control before taking easing action. It's also wants to mention that the UK is lagging behind, given the sluggish economy there with higher inflation, wage growth, etc. So the first cut by the Bank of England is only expected to come in August. But we stay tuned. We don't have a crystal ball, also in light of what's happening also at the macroeconomic environment with the wars in Ukraine, Gaza, etc. US elections expected in November. So we will wait and see, but definitely this will also contribute to some volatility on the market. If we move to the next slide, is just a little bit so in anticipation of those interest rate cuts, we've seen that the Q1 of this year, we've seen a positive trend for public equity raises, not only at a global scale, but also in Europe. So on the first graph, if we look at the global picture and comparing the first quarter of the year to the same period in 2023, we've seen 7% increase with 156 billion in public equity raised. We've seen large transactions, like, for instance, the sale of existing shares in Haleon by Pfizer. We've seen the 2.4 billion IPO of Galderma. We have also seen significant secondary blocks on the market as investors, they want to monetize on the back of share price appreciation. And we also see that the deal volume increasing, and this is expected also to increase further in light of interest rate cuts. If we look at the graph on the bottom, on the European side, also we've seen more than 30 billion in equity raised. It's just like a slight increase, if you want, versus the same period last year of 1%. And after the absence of large IPO activity, you know that the IPO window has been closed. In 2023, we've seen some recent stock listing changing the IPO sentiment in Europe. So conducive market conditions leading also companies outside the life science space, like, for instance, Renke Group AG and the drivetrain technology, or Planisware, like a B2B provider of software, that they re-entered the market after they shelved their listings last year. And also before Easter, we've seen also two major listings, Douglas Pharma and the perfume business, and the Galderma IPO that I mentioned earlier. Both IPOs were successful, generating strong demand from long-only investors. But what is keen to mention, for instance, if we look at the post-IPO performance, Galderma closed the quarter above its IPO price, while Douglas closed it down. So basically, blue chip companies like Galderma are being opened, if you want, with open arms, while companies like Douglas, seen as good but maybe not best in class, are really struggling to get the momentum you want to secure a good post-IPO performance. Now, on the next slide, we will take a closer look about what's happening in the life science and healthcare sector. So we see basically that things are moving in the right direction, as the rally we've seen in October 2023 continues to be supported by positive investment sentiment, both when it comes to M&A and follow-on transactions. But everything is data-driven, so you really need clinically meaningful data readouts to be able to bring your company or asset to the next level. Also, the US IPO sentiment continued to move in the right direction, paving also the way, hopefully, for more IPOs that we'd expect to see in Europe in the second half of the year or early 2025. So if we look at US IPO activities over the past 2 weeks, we've seen Boundless Bio, which is a phase 1 company in precision oncology, pricing 100 million IPO, and Continuum Therapeutics, which is a phase 2 biotech focused on IPF and MS, pricing as well another 110 million IPO. So this is really fantastic news. But worth to mention that the key lesson learned from the previous year, that for early stage company not to go public when still preclinical, maybe to remain private, to generate clinical proof of concept data before considering to IPO. And most importantly, to have enough news flow and key catalyst to make sure that you have a healthy share price performance post-IPO. Because if we look at the past year, very few preclinical companies IPO'd, companies like Telomere, Metagenomi, and they both had a negative post-IPO performance. The only exception we see is Apogee Therapeutics in the I&I space, which raised 300 million in July last year, and currently showing a fantastic performance of 290 plus post-IPO. So we really stay tuned to see what will happen also in Europe, because we as a bank, we're in touch with many high-profile European companies, all at the clinical stage, working on IPO readiness. So hopefully we'll see some crossover type of investment coming back to markets in the second half, and some IPOs early 2025. So we stay tuned. Moving to the next slide, it's also an interesting thing to share here with the audience, because Recently, we see on the life sciences space a preference for a PIPE, private placement structure, versus the traditional accelerated book build transaction. So if you look, for instance, between Q2 last year and Q1, you see really a sudden uptick in demands with a surge in pipes, with volumes increasing nearly sixfold. Basically, for development stage biotech companies, pipes are being more and more used to raise capital versus the traditional ABB. And in these kind of transactions, investors are well crossed, and they are being given the privilege to be exposed to certain level of confidential information, like, for instance, clinical trial data. And in return for receiving those info, they could face some restrictions and lockups, preventing them from trading until the information becomes public. However, there are some concerns that these pipes are moving too swiftly, and not all institutional investors would have access to these favored deal terms, because in the end, you really will cross maybe a handful of investors. So it's a short number of investors being exposed to the data, and sometimes it leads to some level of discontent from existing shareholders that they are not able to participate. But despite this, there is no sign of a slowdown, and for the parties involved, those pipes transaction remain so far win-win scenarios on the market. If we move to the next slide, wanted a little bit to share with you an overview about the recently priced European life science transactions between August and year to date. As said, we see more pipes versus ABB, with most of those transactions done at a discount. But if you look at the table, the discount varies a lot. So we've seen like a minus 1% discount for a company like Inventiva, versus a minus 50 for a company like Renalytix. And very, very few deals were done at a premium. Pharvaris, for instance, they were able to do this at plus 15%, companies like Egetis plus 2%. But what is worth to mention, if we look at the slide, that there is really a clear line in the biotech space between winners and losers. So successful players, for instance, like Autolus, CRISPR, Pharvaris, could easily raise more than 200 million, attracting high-quality funds with deep pockets, etc., while companies with a small market cap, illiquid stocks, etc., really struggle to raise equity, as investors, as I mentioned, they're very data-driven, and they are looking for stellar data to be able to participate in a meaningful race. And if we look at the next slide, this is really a nice transition to those companies struggling, if you want, to raise a plain vanilla equity, and where alternative financing structures could help, if you want, plugging the gap, especially for companies having difficulties to do a PIPE and an ABB or a rights issue, and they have basically to rely on alternative financing options like structured equity with warrants, venture debt, trial financing, etc., to extend their cash runway and to continue funding their clinical development programs. We also see the European Investment Bank coming into play, with several biotech players, for instance, providing to them venture debt loans in the range of 20 to 50 million as a way to support innovation in Europe. We're also experiencing lots of competition in the debt space, so it has never been that busy. When I joined Kempen in the 2018, it was only about equity. No one wanted to speak about debt because you don't want to put debt on your balance sheet. But now it's like a tool that many biotech companies are using, and it's super competitive. You literally get a term sheet at your desk after one call with a debt provider. But it's also worth to mention that in some other cases, alternative financing options come from a position of strength. So for companies with a very solid cash position, like for instance, Zealand Pharma, they got in December a 90 million venture debt facility from EIB, and we were there the financial advisor, but this was done from a position of strength to extend further their cash runway. Other example, Ascendis Pharma, the Danish company that sealed a 139 million royalty financing agreement with Royalty Pharma, basically to monetize on royalty streams that will be driven by Skytrofa sales in Europe. So we see really all options on the table, and it requires a lot of creativity to help biotech companies bringing their assets to the next level. So that was basically the overview on the public side. Maybe in the next slides, we could delve a little bit about what's happening on the private side of the business. So if we go to the next slide, Luis. So basically, we see financial rounds moving at a lower pace versus last year, still with some pressed valuations, except for hot therapy areas that we'll tackle later and some cutting-edge technologies. So if we look at the first quarter, you see 47% of the Series B and C had a deal value between 50 to 100 million and 38 between 25 and 50 million. And while last year we've seen 30% of the deals exceeding 100 million. If I look at areas like ADCs and radiopharmaceuticals in oncology, they remain very bright spots in R&D. But beside this, we see fatigue, some level of fatigue on the investor side when it comes to immuno-oncology, because it's super crowded field. You have at least 10 assets per target, so it requires a lot of differentiation. So despite the fact that if I look at the global biotech pipeline, 40% it's still driven by oncology, but really big transformative and breakthrough assets are rare, and 60% of approvals coming from PD-1. And what's a real challenge also, both on the investor and the pharma side, is that it's hard for them to see significant clinical outcomes. So it really requires a lot of differentiation on the IO side. Now, if we move to the next slide, just to share with you, if you want, deal participation. So where is the money coming from? So if we look at the top 10 investors over the last 5 years, it remains consistent over time. So you see, for instance, funds like Fabian, Novo, EQT, Sofinnova taking the lead on the European side. And also these funds continue to fundraise and raise large amount of money. So Fabian last year, they did the largest fundraising to date with 1.35 billion, which included 600 million for their growth fund, basically to support the expansion of late-stage life science companies. EQT also closed their dementia fund at 260 million, which is above the original target, as a way to bring new treatments for patients suffering from dementia. So there's really a lot of money available in Europe from high quality investors. And if we look at the largest European fundraisers, we've seen massive 100 million plus deals. These are things that we didn't see a few years ago, because usually for a Series A, you would see a maximum 25 million. Here we're exceeding the 100 million threshold. So you've seen deals by Apollo, Amolyt, which was recently acquired by AstraZeneca. And also during the first quarter this year, we saw German Tubulis on the top of the list, raising 128 million a few days ago in the ADC space, which was led by EQT and Nextech. Also, we've seen the Swiss US company Alice Pharmaceutical, which is a preclinical stage company developing small molecules for skin diseases. And it's basically a merger of 6 asset-centric assets coming from Medici to create a kind of an R&D centric multi-platform with more than 12 assets. So this company raised 100 million in seed investment and aiming to raise an additional 200 million later this year via Series A. So you see a lot of things happening on the private side of the business. And we see big US funds, maybe like Array or BMED and others, still focusing more on the US side of the business when it comes public or private, because valuations are not adjusting with the rest of the market in Europe. But still, when it comes to late stage opportunities and hot areas, they could still, of course, get traction from tier 1 US investors. If we move to the next slide, looking a little bit at M&A deal volume, I'm afraid to say that M&A deal volume remains low in quarter 1. So after the boom we've seen in 2021, the overall deal flow tapered off again in 2023. But despite a couple of multi-billion deals which drove overall deal value, like the BMS acquisition of Karuna or AbbVie acquisition last year of Cerevel and Immunogen. But despite the fact that the M&A deal volume remains low, we've seen M&A activity in the life science sector to continue at a steady pace. And also as a bank, we're working on several mandates being on the buy side or sell side. So there is a lot of things happening behind the scenes, which could generate positive momentum. And of course, it remains very much data driven. And we see Big Pharma, of course, they sit on tons of cash. We see them pulling the trigger, deploying their firepower after having strategically over the recent year divested some assets to free capital. And also large biotechs also are now being more bold and doing more acquisitions. So we've seen last week the acquisition of Profound Bio by Genmab for 1.8 billion in cash, which is another deal in the ADC space. So hopefully there will be more deals as we move forward through the year. Moving to the next slide, it's just a little bit to discuss a little bit about how we see things evolving. So we see that the challenges remain for biotech in Q1, moving at the same pace as Q1 last year. But what is really important to mention, and we already started seeing this last year, this move from rare precision medicine, orphan rare diseases, small opportunities, to really to big and broad patient opportunities, the B2B models. And we've seen also COVID players, for instance, like Pfizer and Moderna, they have been really hit hard as the vaccine windfall is over and they lost more than 200 billion, while it's a golden age for players, for instance, like Novo Nordisk and Lilly moving to the top, given this shift into large track classes with blockbuster potential when it comes everything around obesity, metabolic disorders like CKD, heart failure, neurodegenerative diseases. So these are like the hot areas where high quality investors are pulling a lot of money. Also, the I&I space is also getting a lot of traction, and there it's crowded, where we see more than 330 drugs under development across 75 indications. So a lot of things happening in the I&I. And as mentioned earlier on oncology deals moving from rare onco indications, because it's a real challenge to screen and recruit patients, to focus maybe on improving some existing platforms when it comes to the radiopharm business and ADCs. If we move to the next slide, just a little bit to show you the picture of the recent M&A transactions. So we see that though large cap EU and US biotech acquisitions are gaining again some level of tractions, we saw in Q1 an uptick in jumbo deals. I will not discuss all of them, but maybe the most important or recent ones, like Cardior acquisition by Novo for 1.02 billion, including upfront and certain development and commercial milestones. They haven't disclosed the split between upfront and the other payments, but this is a phase 2 asset for the treatment of heart failure, which is again around metabolic disorders. AstraZeneca acquisition of Fusion, which is a clinical stage company developing next generation radioconjugates, and this was done for 2 billion and a 97% premium. CymaBay acquisition by Gilead, again at 4.3 billion in total equity, and this will help, of course, Gilead to complement their existing liver portfolio. And one of the most fantastic deals we've seen is Novo Holdings acquiring Catalent in an all-cash transaction of 16.5 billion on an enterprise value basis. So really, we see that specialist investors luckily are benefiting from such premium offers, and as a result, they will hopefully have additional capital to deploy in the remaining of 2024. Moving to the next slide, it's more about contingent value rights. I know that Julia will tackle this in more details in her presentation. Maybe what's worth to mention that if we look at the past year, 50% of the deals had a CVR component, and this is mainly to bridge the gap in valuation, which couldn't be matched by standard takeover premium. We see this trend changing a bit in 2024. So we're seeing less CVR. So if I look at the 10 deals, only 2 out of 10 had a CVR component, which give us the basically that valuation gaps are narrowing and increased structures to bridge value gaps are there. So this is also, of course, good news that, yeah, we're returning to the old days. Moving to my last slide, just a little bit to briefly summarize both on M&A and ECM that there are multiple drivers in 2024 that are conducive to this positive trend. As mentioned, enhanced market conditions, interest rate cuts will be help to support public equity raises in Europe and at a global scale, with IPO window open up again. As mentioned earlier, valuation gaps are narrowing. Big pharma are still driving the M&A market, especially that many blockbuster drugs will lose patent exclusivity in the coming years. So the industry is really facing some major challenges to blot this gap in revenues, and they would rely on inorganic growth. And last but not least, there are many high-quality funds in Europe that can deploy significant cash for new opportunities in the remainder of 2024. Thank you.
Thank you, Nadine. Thank you very much. Okay, so thank you, Nadine, for this for the good talk today. And now we are going to pass on to Julia Schieber from Baker McKenzie, and she's going to give us a legal take on when to do M&A and when to do licensing. So, Julia, the floor is yours.
Thank you very much, Luis, and happy to give this presentation today. So a few words on our firm. We are a truly global law firm with 74 offices in 45 countries and nearly 7,000 attorneys worldwide. And the life science industry is really one of our core industries. We have more than 800 lawyers that focus on advising clients in the life science industry. And actually, the life science industry made us to what we are today. One of our first important clients was Abbott. And when Abbott started expanding globally in the 1960s, we simply followed them and made sure that we opened an office wherever they were to be able to advise them. And this has not only led to Baker being one of the largest firms in the world, but also adds up to more than 60 years of experience in the life science industry. And we are very fond of this part of our DNA. So what's on the menu for today? We will quickly look at the basic deal structures and the triggering elements for choosing the right deal structure. We will then compare different types of deals and discuss how to determine the scope of a deal and how to structure the financials. So let's start with the basic deal structures. I have listed co-development, co-marketing, licensing, asset and share deal here. But as you're likely well aware, the deal structures are fluent, and there are many more ways to title these types of deals. On the left, you see share deal and asset deal, which is usually covered under M&A, but we will discuss later on that there are quite big differences. And then co-development, co-marketing, and licensing is usually covered under the overhead licensing, partnering, or collaboration. And there's no clear delineation. Most licensing deals are not straight licensing deals, but contain an R&D element. And almost all R&D collaboration agreements contain licensing elements. The same is true for co-marketing agreements, which are also frequently referred to as co-promotion or co-commercialization, co-detailing, or other types of titling. For the ease of reference in the following, I will cover all of these types of agreements under the term licensing. Starting point is, of course, the objective of the seller or the licensor. If the objective is an exit, a share deal is often the ideal solution. But sometimes if you are, for example, a single asset company and you cannot find a buyer that is interested in global rights for that asset, and hence is also willing to put sufficient money on the table to match the company valuation, a gradual exit through regional licensing deals may be the only option that the shareholders may have. Another big objective is funding, and that usually happens through licensing. For example, if a biotech company out-licenses its phase 1 asset, this will not only fund the other further clinical development of that asset as the pharma partner will take over, but the biotech can also use the upfront and the milestones received from that out-licensing deal to progress its other pipeline assets. This being said, the funding can theoretically also be achieved by a share deal or asset deal, but it is much more complicated. For a share deal, you first have to establish a new company and then carve out and push down all the relevant assets and liabilities relating to the specific compound or product that is going to be divested before then being able to sell the shares in a second step. And an asset deal sounds attractive, but it comes with other risks. For example, the risk that employees of the biotech company that have worked on the development program transfer automatically by operation of law to the pharma company taking over the program. And I will get back to that on one of the next slides. Another important, probably rather second line objective that is, in my view, not always sufficiently considered in practice can be the building up of capabilities and resources. For example, if an early stage biotech company wants to build up capabilities in clinical development, it makes sense to not choose a straight out licensing deal structure, but include a co-development element for joint clinical development. This also usually happens for commercialization in case of licensing agreements that contain co-promotion elements and which biotechs often try to use as a tool to build up their own field forces. However, in this respect, you need to be careful, and it is usually recommendable to structure it either as an option to opt in, or at least to have an option to opt out in case the funding of the promotional activities overstretches the financial resources of the biotech company. The structuring of the deal will also depend on the target. In case of a single asset company, out-licensing the one asset on a global level usually doesn't make much sense, but instead an asset deal or a share deal should be chosen. If, on the other hand, you're a multiple asset company or a platform technology company and the acquirer is not interested in all the assets or the platform as such, but only in one therapeutic asset, then usually out-licensing makes most sense. Another triggering element is, of course, also the valuation and the risk appetite of the buyer, and we will take a look into this in more detail when we talk about the financials. The scope of the deal is also important. In case of a split territory or a split field deal, usually a license deal is preferable over an asset deal. The reason being that while you can transfer patent rights on a country-by-country level, you cannot split know-how geographically and sometimes also not between fields of application. So if you transfer the ownership to know-how to one party, which is what you do in an asset deal, you cannot grant rights afterwards to that know-how for other countries or other indications. And one of the last triggering elements I would like to mention is the buyer readiness. For a licensing deal, the licensee needs to be ready to take on the assets, meaning that the licensee needs to have the resources and the capabilities to progress the asset. While for a share deal, you can rely on the infrastructure and the capabilities of the target that you acquire. To give you an example in this respect, in the end of last year, one of our clients wanted to divest one of their commercial assets due to an internal shift of strategic priorities. And the asset had been launched in some countries, in others the launch was being prepared, and they conducted an auction process. And after exchanging term sheets with bidders, we initiated contract negotiations with the two of them. And the interesting thing was that we were negotiating a licensing deal with one of the bidders, while we were negotiating an asset deal with the other bidder. And the objective for the deal was the same, right? The client wanted to divest the product. What one of the bidders said, we want to acquire the entire business pertaining to that product, including the commercialization, infrastructure, and the field forces, as we are currently not having sufficient people to take on the product and commercialize. So they wanted to do an asset deal to acquire the complete business. And the other bidder said, our pipeline is half empty because one of our phase 3 assets died. We have sales reps sitting around, and we want to acquire the product to fill our pipeline and make use of the commercialization infrastructure that we have built up. So for them, the licensing structure was the preferable structuring. And I think this example shows how, as some deal parameters are different, the whole structure is effective and the whole structure is effective and the whole deal structure may be different. So let's go into a bit more detail and now compare the different deal elements. So for a share deal, all assets and liabilities, including IP ownership, is transferred by the transfer of shares. For an asset deal, only certain agreed assets and liabilities, usually including IP ownership to the patents and the know-how, are transferred by transfer of single assets. This means that you need to be very careful in determining which assets are actually transferred, and you need to be very careful in identifying these assets. And then on the other hand, for a licensing deal, no ownership to the IP rights is transferred, but a non-exclusive or exclusive, most often exclusive license is granted under the IP rights to certain product. And then there may be other elements, like other assets may be transferred, for example, regulatory approval, inventory, raw materials. So for a licensing deal, determining the scope of the licensing deal is crucial. And the scope is usually determined by the grant of rights. And key definitions there are licensed technology, licensed activity, licensed compound, and licensed product, the field and the territory. The tech transfer clause, which deals with, for the licensee, gaining actual access to the know-how and being able to make actual use of the license. And then other clauses determining the scope are the non-compete provision, option rights, and right of first refusal. So for the one key definition which determines the scope of the license is always the license compound definition. And this can be broad or narrow. So for example, it can be a specific compound, but it can also be a specific compound plus specific plus backup compounds or follow-up compounds. It can also be broader, covering any compound that falls under the licensed patents, or it can even be broader and cover all compounds that have a certain mechanism of action, or all compounds that target a certain target, a certain antigen. So it's really important to get this definition right, because it determines the entire scope of the license grant. And then other crucial points that need to be considered for tailoring the scope is all IP licensed exclusively, or are some parts licensed non-exclusively, for example, platform technology? Then is the license grant to specific patent families and know-how, or all patent rights and know-how that is required and useful? And then lastly, is it only covering IP that is existing at the effective date of the license agreement versus all IP existing and, including future IP that may exist during the term of the agreement? So let's now move to the financials. For an M&A deal, the classic structure is that there's a purchase price, and the purchase price is paid upon closing of the transaction. But for early stage deals, we see more and more often that there are contingent value rights, meaning that there are milestones and royalties. Same is true for an asset deal, with the difference that the valuation is tied to the transferred assets. And for licensing, the classic structure is a three-part tariff consisting of the upfront payment, milestone payments, and then the royalties or the profit split. So if we take a closer look to this into this deferred payment structure or contingent value rights, it's three-part, right? As I already mentioned. So it's the upfront payment, the milestone payments, and the royalties on net sales. And the background is that in certain cases, the overall non-adjusted, non-risk adjusted deal value may be in the several billion dimension. But due to the inherent R&D risks that you have in pharmaceutical R&D, it's not all paid upfront, but it's paid when the de-risking elements in the form of milestone payments occur. So in that sense, contingent value rights or the deferred payment structure, it's a mechanism to share the risk of like the inherent risk of the R&D between seller and buyer, or licensor and licensee in case of a license agreement. So the upfront payment, that's payable upon closing of the transaction. And for licensing deals, this is a kind of technology access fee that the licensor receives as a compensation for the investment already made and for the innovative approach. For the M&A deal, it's also paid upon closing, and it's either a fixed price like a lockbox or closing accounts, which means that there's a purchase price adjustment at closing. Then we have the post-closing milestone payments, and these you can there you can differentiate between the development and regulatory milestone payments and the sales milestone payments. And for the development and regulatory milestone payments, these are tied to de-risking elements. So, for example, initiation of clinical trial, submission, NDA submission, or regulatory approval. And then the sales milestone payments, they are tied to the achievement of certain sales thresholds. And then the royalties, finally, they are a way for the licensor or for the seller, if you also have it in an M&A deal, to participate in the profit that is made with the sales of the product. And there, the crucial or the terms that are usually under discussion are the royalty rate, the royalty term, and the net sales definition. This deferred payment structure results in the seller or the licensor having a continued interest in the success of the program, because the full value of the asset of the transaction can only be realized if the milestones are actually reached, if the product is actually launched, if there are sales. And therefore, the deferred payment structure usually comes with diligence obligations that are imposed on the licensee or buyer. And there you can either have specific diligence obligations, which would be, for example, you have to achieve a certain milestone within a certain period of time. For example, move to the next clinical trial within the next 3 years, or something tangible. Or you may have a general CRE clause saying that the buyer or licensee must use commercially reasonable efforts to develop and commercialize the program, the product. Another question that is usually under discussion is whether the diligence obligations are, you take a subjective or an objective approach, meaning that when determining whether the buyer or licensee is using or has used commercially reasonable efforts, do you compare it to the efforts and the resources that the buyer or licensee would usually use for its own programs, or that's subjective, or do you compare it to the efforts and resources usually used by a comparable player in the pharmaceutical or biopharmaceutical industry? And then lastly, you can either tie, and that's what we usually would do, you can tie the diligence obligations to a development plan and a commercialization plan. And then in addition, this comes with reporting obligations because the seller or licensor needs to be in a position to determine whether diligent efforts have been actually used. So there usually you have reporting obligations, which means that the licensor or seller would receive reports, which then enable them to assess whether the licensee or buyer is using commercially reasonable efforts. And then, like just mirroring that, right? The seller or the licensor has information rights. That's basically, mirroring the reporting obligations. They may also be audit rights, which is usually highly negotiated because this is, of course, a very sensitive topic. And there you also need to keep in mind competition law aspects, right? Because this may give the seller or the licensor access to very highly sensitive information, which may not always be allowed under applicable competition laws. And then the crucial question is then what happens if there is a breach of the CRE obligations? And this is a little bit different for licensing deal versus M&A deal, because for licensing deal, you have the termination, because the licensing deal, it's a continuing agreement that may be terminated, which then usually means that the rights stop, and then you may even have a reversion of rights to the licensor. But in an M&A deal, the deal has already been closed, so the shares have been transferred, so you cannot reverse that. So for an M&A deal, you have the damage claims, and then you may have penalties to basically, have another kind of threat tied to the diligence obligations. So for the royalties, the royalty term is really important. Usually the royalty term is tied to exclusivity, namely the expiration of the last valid claim of the licensed patent. And then what we usually see in addition is expiration of regulatory exclusivity, meaning data exclusivity or pediatric exclusivity. But in addition to that, the licensor may expect a minimum payment term. So this is why we usually see, that the royalty term terminates with the later of the expiration of the valid claim, regulatory exclusivity then, and then a certain minimum term ranging from 10 to 15 years, whereby I would say like 10 to 12 years is what we commonly see, following the first commercial sale of the product. And then issues that may become controversial in this respect is the valid claim definition. Namely, is the reference point for the valid claim, is it only the licensed patent or also certain foreground patents that are for inventions that are made during the R&D program going on under the agreement? Then you can limit it to composition of matter patents versus all patents, are only issued patents or also patent application in scope, etc. And then in addition to that, you have the royalty reduction. So you usually have a step down after the regulatory exclusivity. If you have this minimum term of 10, 12, maximum 15 years, you have a step down after the expiration of exclusivity. So the valid patent terms expire or the regulatory exclusivity expires. Then you may have an additional step down for generic entry. Then you have anti-royalty stacking, which means that if the licensee or the buyer has to obtain a freedom to operate license to make use of the licensed technology or then the royalties that need to be paid to a third party are shared. And then there are other royalty reduction mechanisms. For example, we recently see royalty reduction mechanisms due to the Inflation Reduction Act. And it is usually quite important to make sure that there is a royalty floor, and this may even be more important if there is certain in-licensed IP. So if there is a certain third-party base royalty that the licensor has to pay. Instead of royalties on net sales, you can also have a profit sharing, which means the difference being that instead of a percentage of net sales, which are the royalties, the licensor receives a percentage of net profit. There, the calculation of net profit is often controversial because in addition to the deductions that you usually see for the net sales definition to get from gross amounts to net amounts, you have additional deductions that can be made to get from net sales to net profit. And these are the allowable expenses that are used for the the commercialization of the product, or the COGS that are required for manufacturing of the product. And these are very often controversial and require a lot of discussing the details of the definitions. In early stage deals, the profit split will often go along with the split of the development, regulatory, and launch costs. And this may impose on the biotech, this like we've seen before COVID, we've seen a lot of these profit sharing, sharing of development cost deals. But this goes along with an increased risk also for the biotech company, because you do not have only the greater financial participation, but you also have an increased risk for the development cost. So it's very important to have kind of a safeguard in the sense of a cap or an opt-out in case the funding of the development program overstretches the financial resources. And I guess the current situation where funding is quite difficult, as we also have heard from Nadine, this goes along that we see this request for profit sharing of development cost deals a little bit less often than before. So comparing other deal elements, we already discussed the buyer readiness. So as I said already, in a share deal, the buyer can rely on the infrastructure, on the resources, on the personnel of the target. In an asset deal, this can be the case, but in a more limited way. And in a licensing deal, the licensee needs to have the infrastructure to take on the asset. Meaning, you need to have in particular, the personal resources and also the capabilities to further develop the asset if it's still in development. But there we often see R&D collaboration elements which then give the in particular for preclinical development, where then the licensor will continue the development of the asset for a certain amount of time. Then in a share deal, the employees, they remain in the target. In an asset deal, since this is the transfer of an entire business, in many jurisdictions, all the employees that belong to that business, they also automatically transfer. And this is not always sufficiently considered, from the beginning in an asset deal. Because, for example, we often see that for the lead program, you have a biotech, and there's a lead program, and then most of the personal resources, they actually work on that lead program. And then if the lead program is divested, and this is done by way of an asset deal and not by a licensing deal, then these employees, because in the past they have mostly worked on that program, they would, by operation of law, transfer to the buyer. But usually this is not what the parties want. Usually the parties want that the biotech company wants to retain the employees and then wants to shift the employees to other assets in the pipeline and then further progress these assets, while the pharma companies say we have our own employees, so we don't need the employees. And I've quite often see then the structure shifting from an asset deal to a licensing deal for exactly this reason. And because it had not been considered sufficiently in the beginning. And then for the licensing deal, as I already said, you have no changes, so the employees remain with the licensor. Then the governance, this highly depends on the financial structure, but I think in general you can say for a share deal you have less joint governance than for a licensing deal. So for licensing deal, you usually have this joint steering committee where the parties discuss the further development of the program. And for the share deal, you may have it due to the diligence obligations if you have contingent value rights, but it's not always the case. And then termination, that's quite different. For a share deal, termination is only relevant between signing and closing, and then only for very specific reasons. After termination, the deal is implemented and termination becomes irrelevant. The same is true for the asset deal, whereas for the licensing, it's a long-term agreement and long-term agreements can be terminated. So usually a lot of time is spent discussing the grounds of terminations and the effects of termination. So, you know, what happens if the licensee terminates the program for convenience? Are the rights reversed? Can then the licensor continue the development? Are there post-termination royalties, etc.? And then lastly, the scope of the due diligence. For the share deal, you have a comprehensive due diligence. For the asset deal, it's more limited and tied to the assets that are transferred. And for the licensing, it's even more limited, and most focus is on the IP, on existing in-licensing agreements. We see more and more, due to the difficult funding situation, a limited financial due diligence, but generally it's much more limited than in a share deal and an asset deal. So that's all from my side, but I'm very happy to take questions.
Well, Julia, thank you very much. It was a great presentation. And now we'll go on to the Q&A session, and let's wait and see what questions the people have. And now we'll start the Q&A session. And we have some questions here. Let's see. I think this is a question for you, Nadine. ABB, what does it stand for?
Yeah, maybe I should explain, given that the audience is more on the BD pharma side. So it's accelerated book building transaction, and it's basically when it's a type of offering in the equity capital market. So when a company wants to raise a capital, this is mainly applies for listed companies that have done their IPO, and they usually do the follow-on transactions, and there could be several ways to do this, and one of them is accelerated book building offering. Basically, in most of the cases, you would wall cross some investors before launching the transaction in the public domain to see if there is an appetite for a deal or not. And then once it's launched, it can be done overnight, and it's basically open to the market. So allowing investors on the street basically to buy shares.
Okay, thank you very much, Nadine. Okay, we have another question. I think this one is more for Julia. Does it make sense to agree on perpetual royalties?
So we usually, like, perpetual royalties would be royalties until, like, you know, basically what it means would be payment obligations for as long as the product is being commercialized.
Correct.
And we usually don't see that. We see for profit split deals that these obligations, they are as long as the product is marketed. So you could say it's not perpetual, but it's like for as long as the product is on the market. But for royalties, you don't see it. For royalties, you really see the term which is tied to the patent term, the regulatory exclusivity, and then the minimum, a certain minimum term. And then depending on how long your patent term is, you know, it may or may, the minimum term may or may not be relevant.
Okay, thank you very much, Julia. Another question here. This one is also for Julia. How do you suggest to protect the licensee against the risk of bankruptcy of the licensor?
That's a super tricky question. And actually, in most continental European countries, it's not possible to protect the licensee in a good manner against the bankruptcy of the licensor. And this is then always a question that has to, no matter what choice of law you make in the agreement, it's a matter of question of the law where the licensor is incorporated. You know, so for a Swiss company, a Swiss licensor, it's a matter of Swiss insolvency law. And actually, as I said, it's like really complicated to usually in that's true for Germany, but that's true for Switzerland and other jurisdictions in Europe, has the right to terminate the license agreement. We don't see that problem being so problematic in practice. But what we do is that we include at least some safeguards into the agreement. For example, reporting obligations, so that, you know, and I think it's smart to already include that in the agreement if you have doubts about the financial situation of the licensor. So they have reporting obligations on their financials. And we publicly available. We include a right to an early handover to make sure that, you know, if there is a certain R&D element, and that there is an early handover so that you are in a factual position to continue with the product. And then there are other elements. It's very complicated. I think it's probably too much to answer right now. But if you shoot me an email, I've actually quite recently, I've written an agreement with one of the Roche licensing experts on exactly that topic. So if you shoot me an email, I'm happy to share that article with you.
Thank you. A question for Nadine. Why are the PIPE deals now more popular than the ABB deals?
Yeah, it's a good question. It's like, now that we explain what is the background of an ABB, so there are some differences, if you want, and nuances between those two types of offering. So if you look, for instance, at the structure, when it comes to a PIPE private placement, there is a high degree of structuring flexibility, because you could avoid some potential market speculation, while in an ABB, it's a limited flexibility to customize the offering because of the public nature of it. And also it depends about the way you would treat investor. So in a PIPE, for instance, you would give a selective invitation because you're giving an information advantage. So some investors, they would be, privileged to receive this type of confidential information, which may, of course, upset some existing shareholders. While in an ABB, all eligible investors can participate. So it's a kind of an equal information playing field. Also, when it comes to the price setting, it's also very much different, because when you would do an ABB, this will be set through the book building process, and it could lead to a wide discount, while for a PIPE transaction, it's typically close to market price, because you have the opportunity to do bilateral, if you want, negotiations between the company and investors, which are of course facilitated by the banks. And last, on the liquidity side, when it comes to an ABB, it can enhance liquidity post offering, because it depends on the depth of the book, how multiple times the book is covered, versus a PIPE where it's a concentrated placing, because you're limiting this maybe to a handful of high quality investors, limiting liquidity, and participating investors may be locked up. So there are several nuances there, but private placement are being seen more attractive in this current moment, but it's never a dull day in ECM, and things of course continue to change.
Thank you, Nadine. This one more for Julia, and I think for both. For a smaller company looking to get rid of or create value for non-core assets, what is licensing preferable over divestment, or vice versa? What are the advantages of each one? Maybe we can start with you, Julia.
Do you want to? Okay, yeah.
Can you hear us, Julia?
Oh,
okay.
Yes, I can hear you.
Okay.
Can you hear me as well?
We lost you for a second, sorry.
Can you hear me?
Yes, we can hear you now.
Hello, can you hear me?
Yes.
Okay, perfect. So I was just saying, it very much depends on the asset, right? So the divestment in the sense of it may make sense if it's really clearly, if you can really clearly separate it, like you don't have a platform technology, you do not have any underlying core technology that also covers the product, because if you have that, then it may not be able to have a straight asset deal, but you may need additional licenses, which makes all more complicated. So I think it very much depends on the type of asset that you have. To structure the deal. We usually see more licensing in such a scenario.
Okay, thank you, Julia.
Yeah, maybe also worth to mention, like for non-core assets, it really depends also on the size of the biotech company, how much cash they have available to progress the several assets they have in the pipeline and resources. So in these years, given the challenge to raise equity and to extend the cash runway, we see many biotech companies really focusing on the lead assets to bring it to the next level, and a little bit keeping aside the other non-core assets, which led, for instance, to some VCs to focus on company creation, because we're exposed to those VCs on daily basis. And say, if you're aware of biotech companies having some assets that they are not able to bring to the next level, those could be carved out as a way to create new companies. But also it could be, as Julia mentioned, an opportunity to seal some licensing deals, especially in some geographies like the Southeast Asia, China, etc., where there are local parties that having the regulatory and clinical expertise to bring those assets to the next level, and which could, through the upfront or other milestone payments, give some non-dilutive funding for the company itself to be able to focus more on its lead assets. So yeah, all scenarios are possible. It depends how much cash resources and you want to allocate between the several things you have in the pipeline.
Thank you, Nadine. So we have a question here from Bilal. In case of a non-exclusive license agreement integrating different technologies, is it common to have focused non-compete provisions with regards to specifics of the asset being developed by the licensee, the combination product, I seem to understand. Julia, I think this one is more for you. Julia, can you hear us? I think we seem to have lost.
Hi, I'm back. Sorry.
Oh, sorry, back. Did you get the question?
Unfortunate. We have like a... Yes, I got the question. Sorry, and I was already talking, but then I was kicked out. So yeah, for non-exclusive license agreements, it's actually quite uncommon to have non-compete clauses in the agreement. The reason being that, and it depends. Like non-compete, I should ask like non-compete on whom, because theoretically you can have a non-compete on the licensor or on the licensee, but irrespective of that, in non-exclusive license agreements, non-compete provisions are actually quite uncommon, whereas in exclusive license agreements, we very often have non-competes, which basically kind of extend the scope of the exclusivity that you get. So yeah, so I guess this question is with respect to non-exclusive, so there it's not common.
Yes.
We do not usually see that.
Okay, thanks, Julia. I think we have time for one more question. Let me see here. Okay, should investors be looking at EU biopharma due to lower valuations, for example, versus the United States? This one for you, Nadine.
Yeah, it's a very good question. I think that being cheap is no longer the argument to buy these days, because many things are cheap. So we see US participations maybe in EU fundraisers declining over the past years, though the largest one in hot fields, hot technologies, continue to see US participation. But if I look at the investor landscape, whether they are from Europe or the US, they're all risk averse. And they basically look at the fundamentals, if you want, of the investment case before taking a decision. And worth to mention that US investors are more sophisticated usually versus European ones. So as I mentioned in my presentation, that US funds, we see them focused on US companies because valuations are not adjusting to the rest of the Europe. But we see them as well chipping in when it comes to hot areas, large transactions, etc. So you have big funds, for instance, like Bain Capital, TCG, etc. They have deep pockets. They have ticket size 50 million plus, so they can only entertain big raises. So if there are like big raises, yeah, of course, why not? And also, as I mentioned, there's a lot of high quality money available in Europe and would, of course, continue supporting most of the European private routes.
Okay, thank you, Nadine. So I think we have just a couple more slides, and then we can wrap it up. Any last questions? I don't see any more. So what we'll have the registration of this webinar will be available to the participants, and we'll be sharing that after this webinar. Okay. So let's go to the last couple of slides, just to remind everybody about our conference again. Can you see this? Okay. Just to remind everybody to register for the conference that we're having in Montreux, 26th to the 28th of May. And also to register, if you want to become a member and register for the Swiss HLG, and please go to our website, and all the information is there. I would like to thank Nadine and Julia thank you for the presentation. I think it was very useful for everyone that joined the call today, and I would like also to thank all the participants for joining today's call. Thank you very much.
Thank you.